Welcome to Insider Events Master Your Money, How to Invest Smart and Build Wealth, presented by Fidelity Investments. Here's our host, Insider Wealth Building Reporter, Ricky Houston.
Hi, I'm Ricky Houston, Wealth Building Reporter at Insider. Thank you for being here with us today to talk about how to invest smart and build wealth. And thanks to Fidelity Investments for presenting this event. Insider's Master Your Money event series is designed to help you take control of your money. Today's show is the last in a series of 4. You can find recordings of our previous events on Insider's YouTube channel. Each live virtual event, like this one today, provides you with more tools and expert insight. Please take a moment at the end of today's event to share your feedback so we can make future events as helpful as possible. You can also use the dashboard on your screen to get more info about today's speakers and find additional resources. And you can submit your questions about investing smart and building wealth, which we'll address throughout the event. Investing in wealth building is becoming more and more accessible. Mobile banking and investment apps are everywhere, and they exist for investors of all experience levels. But the ability to quickly set up new accounts, track company news and price movements, and trade wherever you are doesn't necessarily mean you're going about wealth building the right way. Let us know why you're tuning into this conversation using the hashtag #MasterYourMoney on social media. Now it's time to introduce our guests. Joining me is Dominique Broadway, founder of Finances Demystified, and Ryan McTorn, Vice President and Financial Consultant at Fidelity. I want our panelists to help us find out how to craft the right investing strategy. I'd also like them to explore the mistakes to avoid when investing. We will examine why investing is so crucial in building wealth. So investing for the first time can be very intimidating. If you're a newcomer, you're probably overwhelmed by all of the information and investing jargon you've encountered. So Ryan, what are some common stock market myths you've heard, and what would you say in response to them?
Oh, wow, what a great question. And first of all, thanks so much for having me. I'm so excited to be here and for Fidelity to sponsor this for everyone. I love that everyone's tuning in to try to learn more about investing. So one of the biggest myths, and I'm sure Dominique would agree, is that I have to have a ton of money to start investing. And it's just not true, right? It's get started with, I don't care if it's $50 that you can start with. You know, you can really start to build your wealth, and you don't have to already be that perception of wealthy to actually do it. That would be the first myth, I would say. Dominique, what about you? What do you think about that one?
Yeah, I agree. That is definitely the most common misconception or thing that I hear people say, "Oh, Dominique, I want to start investing, but I don't feel like I have enough money to start investing." And the cool thing, as Ricky mentioned, with technology and fintech, that has totally changed. There's so many different platforms and educational ways that you can learn about investing. You can literally start investing with, as little as some places as little as $5. So I'm really excited that now people are realizing that you don't need hundreds of thousands of dollars to actually start investing. And I know when I first started out in the investment space, in my first internship, I worked at UBS Financial Services, and all of our clients had, $2, $3, $4, $5, $10 million. And that was really the amount of money you needed to have for a financial advisor to sit down and speak with you. But nowadays, thanks to fintech and technology, you can literally start investing with as little as $5. So I'm excited to see that more people are starting to invest now that they realize that you don't need tons, and it's also allowing us to create more wealth amongst so many different communities because people are starting to invest at an earlier age, which is really exciting.
Yeah, absolutely. And to come over the top with that point as well, I think there's also another myth is that not only do I need a lot of, funds and money to start getting invested, but I need a lot to get help investing too. And that's not true anymore, to your point, both of your points, right? And especially, at Fidelity, I know we'll talk about some of the specifics later. I always say you can't be too small or too big to get some level of help, right? And so it's really important to know you can raise your hand. You don't have to do it alone. You can, and that's awesome, but you don't have to. And that's a huge change in the industry, which is great.
I think
100%.
one more myth that I hear often is that you have to know everything about the stock market before you get started. That's the other thing. People are like, well, I don't understand enough. I don't know enough. And one of my favorite places for me to tell people to start investing is start investing into companies that you are already familiar with and already believe in. A lot of times that makes it a lot easier for you to follow along with that company's journey, but also to understand what's happening in the markets. So of course, like anything you do in life, I know I like to know as much as I can about certain things before I jump in, but don't feel like you have to understand every single thing about fundamental analysis and technical analysis and reading charts and all these different things to actually start investing. You can keep it super simple and be able to go ahead and jump in and possibly see good returns over time. So don't feel like you have to know the ins and outs or be a financial expert before you can start.
Oh, absolutely. And I think what we also hear is not only do I think I need to know this, but for some reason there's this perception that I should know this, right? And people say, I'm smart. Why do I know this? Or why don't I know this? I should say, it's okay. Everybody is a specialty in their, part of the world and doing their thing or their job. It's okay. You can't be good at everything, right? And so that's what we're here for. And so again, I love that the technology these days allows you to go as deep or high level as needed. And, it's also amazing that, Dominique's entire business is structured around trying to learn and help. And it's really kind of amazing. So it's a nice shift to see.
Yeah, 100%. There's so many different platforms that can help you get acclimated if you're just starting out. And speaking of which, Dom, I'd like you to dive into the different types of investment platforms and vehicles, not just newcomers, but all investors can utilize when aiming to build wealth.
Yeah, so I mean, there's so many different ways. I mean, I guess as far as platforms go, there's now an abundance of platforms, right? We have, awesome companies like Fidelity. We also have, Robinhood and Acorns and Stash and Webull and TD Ameritrade, all these awesome different platforms that allow you to start investing. Like I said, some literally with as little as $5, right? But then as far as like investment vehicles, where to actually start investing, that will really depend on what your goals are and what your risk tolerance is, right? So let's say if you're more of a risky investor, then maybe, you like, putting all your money into individual stocks. Or maybe if you're not super risky and you don't want to have to constantly manage your investments, you may be more interested in mutual funds or ETFs, which are exchange traded funds, right? So I would say it really depends on what your goals are and also what your time frame is. So looking at your goals, your time frame, and then also your risk tolerance will kind of help you determine like, okay, do I want to, try options, which tend to be a little bit riskier, or like I said, doing stocks or mutual funds or ETFs, and there's like futures and crypto, and there's so many different places that you can start. I would also say, as you're kind of looking at these different investment routes, really think about, not just what your time frame is, but I guess just like how comfortable are you with seeing, your money potentially fluctuate. So if you're just like, hey, I want to set it and forget it, then something like options may not be good for you, right? Maybe something like a mutual fund or ETF where your money is getting spread amongst hundreds or sometimes thousands of different companies is better for you versus stocks where you're just putting your money into one investment. Maybe you're putting, I don't know, $1,000 into Apple and hoping that it grows, but you understand it's going to go up and down over time, right? So I would say those are some things to kind of consider when you're thinking about where to invest, but also like what should you start investing in. And also when you're thinking about where to invest, there's a few different factors you should think about, including, what are the minimums to invest at this company, right? We talk about like Fidelity and Robinhood and Webull. A lot of times they have opportunities to start investing with little as $5, $10, $25, etc. There's some places that may have higher minimums to start investing. Then also thinking about what are the fees, right? One of the reasons why some of these new fintech companies are getting really popular is because they have no commissions or no fees to actually invest, where traditionally, working with a financial advisor or in trading through different, or investing through different platforms would cost you more money, right? So those are some things you want to look into as well. Like I said, looking at what fees or commissions they charge, right? But also thinking about, what are the minimums that these companies are charging. So those are some of the things that you can kind of look at and consider as you're deciding where you want to put your investments.
Yep.
Yeah, and I think the other part of what to think about is not only the platform that you're considering, but also the account type, right?
Mm-hmm.
And sometimes, especially with something called a 401k or what's called an employer sponsored plan, you're actually kind of forced into exploring some of these platforms because the company you work at may have chosen like a Fidelity or something like that, because that's where your plan is, and it's a great idea to really start to participate in things like that. And then when you go to different account types, you also want to think about what the tax implications are going to be about putting money in to the account, or maybe on the back end taking money out of the account or placing a trade. So you have a lot of choices. And again, at a place like Fidelity, we offer all of them. And so somebody like me, my primary role is to help you figure out exactly how to organize all of that, and to understand how all of it works. So it can be overwhelming, but we're here to help. Absolutely.
Yeah.
Great points from both of you. We actually have a couple questions from the audience. The first is, can you explain what options are exactly?
You want me to do that one, or?
Go ahead. Yeah, go ahead,
Okay.
Dominique. That's great.
So options essentially are contracts, right? And I love options personally. I was placing some option trades this morning, but options essentially are what we call their contracts, their option contracts. So they allow you to control hundreds of shares of stock at a fraction of the cost, right? So instead of paying the price that the stock is currently trading at, when you're buying an option, it's like the insurance contract. Did I freeze there?
You're
Back
good
now.
now.
Are we still
Yeah.
there? Okay. So like I said,
Yeah.
why people like them is, like I said, because they do allow you to control hundreds of shares of stocks at a fraction of the cost. So when you are buying options, a couple key things to know is that one option contract equals 100 shares. Okay. So if you're buying one option contract, that is allowing you to control 100 shares of that respective stock. Okay. And then the other thing to understand with options is that there's calls and there's puts. So if you're anticipating a stock price to go up, you're looking at call opportunities. If you're anticipating a stock price to go down, you're looking for put opportunities. So essentially, to keep it high level, that is what an option is. It is a contract, option contract that allows you to control hundreds of shares of stock at a fraction of the cost. And each single option contract equals 100 shares. Okay, and you're not paying the price that the stock is paying at. You are paying what we call the premium price, okay, to purchase those options. So that's essentially what options are without going too deep.
And online brokerages typically offer them, right? You can buy them.
Yes,
Okay.
most online brokerages do offer them. I know some don't, like Stash, I know, which is really popular, does not, I don't think, offers options at the time, or Public, some of the newer fintech companies, but Fidelity, Webull, Robinhood do all offer option trading. However, it is something that you have to apply for. So I know a lot of times people say, "Hey, I opened up my account, but I don't see options." Option trading is something that you have to apply for separately, or check a box and say that you're interested in option trading, depending on the platform, so that they can add it to your account access.
Okay. Wonderful. So the second question is, I want to start investing for my kids. What are some of the considerations that I should bear in mind?
I'll take this one. I would say it depends on what you want to invest for your kids for, right?
Mm.
And what I mean by that is a very common goal for your kids is college, right? It's a big bill. It feels like a looming bill down the road for many, many parents. I know I have twin kindergartners, and it's coming down the road. So it's that is very common use a college saving vehicle that can grow for the specific goal of college. And there's some really pretty incredible tax benefits to having those types of accounts. But sometimes beyond that, the clients that I work with say, I just want to save for their future, right? So depending on how old they are, you might have something that's an account that is specifically for a minor, or you want to help them start to create a retirement account for themselves when they're a little bit older. And so you have a few options available to you, but sitting down to see what type of vehicle you're looking for and think about what specifically you want to save for your children is a really important thought process beforehand, and then you can start to have an answer to where to go from there.
Yeah, and I want to add what I definitely agree with everything that Ryan said, and I think you it is really important to figure out like kind of what your goals are, and then, as your children get older, you kind of figure out what their uh, weaknesses and positive areas are, right? Or strengths in their life as well. So I know, like, even, I have two little ones as well. I have a 2-year-old and I have a 3-month old. I had to think about it. 3-month old as well. So we're doing tons of things. We're putting a lot of things in place for them, such as a custodial savings account for their cash, custodial investment account for their investments. We're also putting in place minor Roth IRAs. We actually have our minor Roth IRA with Fidelity. As well, so that they are contributing to retirement accounts. We actually opted out of doing a college plan for now, because I personally don't think that college will be as important when my children get to be college age as it was when I was going to college. That's just my thoughts, right? And I know a lot of people have their thoughts on how the educational industry and sector is changing, right? So we don't want to have tons of money locked up for college, and then we don't, college, whatever is not as important as it used to be. So we're doing more general savings as we're building up their investments and portfolio. So like Ryan said, think about what your strategy, what your goal is, and what you're saving for, and be realistic. Don't just feel like you have to do certain things just because, oh, everyone's saving for college. But like I said, my kid's 2 years old. I really don't think college is going to be as important 20 years from now as it was when I was in college. So you have to think about your beliefs as well, because if you do have to use that money for something other than schooling, you have to face penalties. So it's really important to get a clear understanding of what your goals are for your own personal family, your children, et cetera, as you're deciding where to put those investments.
Yeah, and I think that's an important point, because those are the conversations I have with my clients all the time, right? Is to help them understand what are their goals. I'm not here to tell them, what they're trying to accomplish. It's here to get an understanding of what they want, and then what's the best vehicle to try to get there, right? And people have all sorts of opinions, as you can imagine. But really to try to demystify all of this, to say, what does it really mean, and what are the implications, and sort of the pros and cons of everything, is really important to understand.
Yeah, absolutely. So I think you both dived into employer sponsored retirement plans earlier. We had another audience question, and the person wants to know if Roth 401ks are a good investment.
Ooh. That's a dependent on your situation type of question, right?
Right.
Which, I hate answering questions with "it depends," but man, it depends, right? On that, sort of situation. And there's a lot of considerations versus, money having to address taxes now, being deferred later, income sources now, income sources on the back end, tax code changes. So, that's a real specific one. And again, I'm probably going to, keep saying this, is like, that is what we're here for, to help you answer that question. And especially, some people on this call right now may have a 401k with Fidelity, and we are here to answer that question very specifically in your situation, right? So don't hesitate to call, don't hesitate to reach out, but it's broader and it doesn't warrant a just blanket answer for everybody. Is it worth considering? Absolutely. And do some research for what your plan offers.
Yeah, I agree with Ryan. I think that, and I know a lot of times like we hate to say it depends, but it really does, right? Because everyone is so different and unique, right? We're all at different places in our lives. So for someone, a Roth 401k may make sense. For somebody else, it may not, right? As Ryan said. But I think with all things, I would say just make sure you're doing something. I've seen people get what they call it paralysis analysis, right? Literally just get so overwhelmed with all the different options, they literally do nothing, right? And when it comes to investing, especially building wealth, the earlier you start, the better, right? The earlier you start saving or investing, the less you will have to save or invest in the future. So, as Ryan said, like everyone's situation is totally different, but don't get so wrapped up in that you do absolutely nothing. So I would say just start saving or investing in whatever options you have. If you have to shift them later, that's fine, but don't delay because you're trying to figure out if one thing is better than the other and you put it off for months or years. Because I've seen people do that. They're like, oh, I didn't really understand my 401k, so I just didn't save. And I'm like, I didn't contribute. And I'm like, no, right? You miss all those years of opportunities to earn, to have your money work for you. So I would say just don't let that completely stop you, but definitely speak with someone, maybe at Fidelity or whatever company you're associated with, to determine what is best for you in your life and your goals and where you currently are.
Absolutely.
Right. I feel like that's a great segue to talk about the different platforms that newcomers can use. Online brokerages are more hands-on, but if you're a hands-off investor, there's something called a Robo-advisor, automated advisor. You can also use financial advisors. So I was hoping, Ryan and Dominique, you could briefly dive into the differences between those three different investment options and kind of discuss the pros and cons in each and who they might be ideal for.
I'll let you kick it off, Dominique.
Okay, yeah, I would say I like robo-advisors. I think they're great. I mean, it's people always joke like the bots are coming to take over all of our jobs, but it's kind of true actually. But essentially, robo-advisors have been able to kind of jump in and for a lot of people provide access to like managed portfolios or provide access to investment opportunities that were traditionally only saved for the high net worth individuals or ultra high net worth individuals. So I would say if you're looking, at robo-advisors, I know some popular ones. I know Charles Schwab has Schwab Intelligent Portfolio. I believe Fidelity has some robo-advisor opportunities. Betterment does, also Elvest. And it's great because it literally allows you just to kind of put your money in, and then the technology put your money into a portfolio based on your investment objectives, based on your risk tolerance and your timeline and how much you can contribute. So I think it's great. So, as a former financial advisor, I do think that they're great because, like I said, it is giving people access to managed portfolios that were traditionally reserved for people, for higher net worth individuals. So I think that they could be great, but just understand with robo-advisors, you're not going to be doing any active trading. With robo-advisors, you're just like, hey, I want to hand my money over to this advisor who now just happens to be a robot, and they're going to manage it and make those changes and changes throughout the years for me, and I'm not going to necessarily be hands-on. But if you're looking to be more hands-on, then I would say don't go the route of a robo-advisor.
Right. And I actually have one more audience question, and I think this is another one for you, Dominique. You mentioned options trading earlier. I feel like with options trading, you have to be very intentional about the different types of investment orders. I was hoping that you could talk about limit versus market orders versus stop limit orders and how those affect the final price you pay for stocks, ETFs, investments.
Yeah, I mean it's when it comes to options, I would say, and we definitely teach option trading in one of our courses, the Wealth Transfer Investing course. It can get pretty deep, but just saying like options they can be very risky. And, it's very important to make sure that you are understanding the prices that you're going in, also understanding the risks that are involved with options. So even something like a market order, right? Kind of going over just the basic order types. A market order means I want in right now. I don't care how much it costs. Just get me in whatever the market's trading at. I don't care, right? That's what that means. So it's kind of like if you go to the store and you're buying a bottle of wine and the wine's $12, you're like, cool, take it. I'll take it. It's $12, right? So when you're executing, that's a market order. Just get me in the market. I don't care whatever price it's trading at. Limit orders are when you're saying, hey, only put my order in if it's at this price. Okay, so a limit order is like, I'm only willing to pay $3 for this. If it's over $3, I don't want it. If it's under, I'll take it. But I only want to buy this at $3 or better. So those are great because it allows you to control what amount, what price you're entering or exiting this trade at. And people like that, like I said, because it does provide that control. And even something like a stop limit order, which is another order type, where you're literally saying, hey, if the stock or option price goes to this price, I want you to stop and get me out of this trade at this price, right? So it's really giving you that control, like stop the loss, get me out, right? Or stop the loss, get me out. So it kind of gives you more control. So even when you're doing option trading, typically you can't do option trades at the market. You're setting a limit price when you're buying those trades. I was putting some trades in this morning and I said, cool, I want this to execute at, I think it was like 95 cents or something like that, right? So boom, I put my limit order in at 95 cents and then I got a confirmation later that my order was executed and filled at that 95 cents. So I was able to control at what price I went in, which was great because after that the price went up, right? So those types of order types, and you have to do your research to kind of figure out what is best for you based on what you're trading. But order types are great in understanding those because it allows you to have more control over your trading and investing instead of just tossing money in and not being sure at what price the order is going to get executed at. And that also helps to control your profits and also limit any losses.
Excellent analogy. And I hope those in the audience who are wine lovers, I hope that stuck for you. That's an analogy that I would have loved to have heard when I started investing. So thank you for that, Dominique. My next question is for you, Ryan. What is your advice regarding diversification?
Oh, I think, especially when we're even throughout this whole, kind of conversation, I think it's really easy for a lot of this to get really overwhelming and really to think, oh my gosh, I should be trading, like everything that Dominique is saying and limit orders and everything like that. And I think diversification is the key to make sure you don't end up with too much or not enough of any one thing. Right. And I think that's really the way to think about it. And a lot of people have a different definition of what their version of diversification really is. But when it really comes down to it, and again, specifically what my role is here for, is to help you understand and think about the big picture always. Right. So we start to say, OK, what am I trying to accomplish with whatever the funds are that you're looking to invest? Is to, like we talked about before, is college a goal? Is retirement a goal? Is buying a house a goal? And when are all of those things kind of projected to happen, for you, right? Are you looking to retire in 30 years or is it 4 years away, right? And the reason I focus on that is because how really diversified or even how risky a portfolio may end up is going to be very much driven by the time horizon or how long until this goal is sort of set to happen and what the goal is, right? And so, example, if you're going to buy a house, you're saving X amount of dollars and hopefully investing those dollars for a particular goal where you need all of the money all on one day to purchase something, right? Versus retirement, whether it's soon or far away, is a big goal for the day you retire, but you also need the money to last for the rest of your life, right? So that's a very different way to invest up until and then at that point ongoing. So the reason I bring all of that up is that's going to be tied to the level of risk, which is also towards diversification, right? And then sometimes people think of diversification only within their, sort of risky part of their portfolio. And the other issue with almost having too much access to information or funds or things like that is that sometimes people think, oh, I have 10 different of the same type of fund and they think they're diversified, but it's actually a lot of duplication over and over, duplication. And so it's trying to understand what you're trying to accomplish that can lead into the level of risk and then the level of diversification you would really need. So, which is kind of the sequence to think about whether you want to start to dive into some of the investments or the ways that Dominique is talking about with trading as well.
Right, and I know I've seen this on for many brokerages. Some offer calculators that help you figure out your time horizon, your risk tolerance, how much you want to invest, for how long you want to invest. So I mean, if you're looking, for a place to start, I think that could be a good option as well. FAQ sections for whether it's online brokerages, automated advisors, crypto exchanges, they're also very helpful. So I definitely agree.
And I think it's also important just like understand like even like what is like diversification, right? So sometimes it's just like what is that actually? I know in the past couple of years we have a lot of crypto millionaires, right? They put all their money into crypto, and it was early on, or maybe Bitcoin, and now we have people that are made 2, 3, 4, 5 more $1 million off of that. They literally had all their money in there, right? So that's an example of just having all of your money into one investment. So you're thinking about diversification, you're kind of thinking about all the different places that you can put your money, but I will also say thinking about all the different ways that you are making money, right? And making sure that your income that's coming in is also coming from different places. So that's another place to be diversified. So I feel like your investments need to be diversified, but your income needs to be diversified as well. I know when I was an advisor back in the day, it was like, oh, you'll put them in an 80-20 portfolio or 60-40, right? And it's like 60% stocks and 40% bonds. And those days to me are gone, right? And so people's portfolios are a lot sexier now. It's, their portfolio may be real estate, and the real estate may be Airbnbs or just, traditional investment properties, or it could also be, you're renting cars on Turo and, using that, or some people are, investing into art or various other collectibles, jewelry. Like people are investing into a lot of different things. So I think we're thinking about that diversification, making sure that our portfolios are also fresh and forward thinking, and also that they are literally just not all sitting into just one mutual fund that may get 6 or 7%, because right now inflation was 3% a year, and inflation is basically the how much the cost of things, the prices of things rise every year, which means that our dollars need to keep up with inflation. So if our dollars aren't at least keeping up with inflation, then we're losing money every year, right? So that's another reason why we want to make sure that our money is diversified, where maybe you have some that may be a little bit more riskier, and then some monies that are conservative, depending on where you are in life and what your goals are. So I think that's another part as well of just some things you want to think about as far as diversification, because some people are like, well, what does that even mean? Like, having money in different places working for you and not just all in one portfolio. And I think also too, inflation, I think I was reading recently, I believe it's like 5.6% now. Inflation's like 5 or 6%, I believe. And so it's like if your money isn't earning at least that, then you're losing money. Now, most savings accounts right now are paying like 0.01%. So that's another reason why this investment conversation is even more important, to make sure that our money is growing for us, because if not, we're literally losing money.
Right.
Yeah, and I think it's a huge point, that, especially going off of two things that Dominique said, and I've noticed this over the past few years, and having done this for a really long time. Obviously, the market has gone way up over the past decade, But even the past few years alone has been a real kind of explosion, and especially in those particular areas. What I find of for some people is that they might make a bet and or over allocate, like Dominique was saying, into different pockets of the market, and then they don't keep in mind why they're investing, and they feel they always have to keep hanging on, so it just keeps going up, right? And I've seen, like to Dominique's point, generational wealth created over the past few years where they started with very little and now they have a whole lot. And it gets really difficult to diversify or move away, even if not with all of it, but with some of it, from the thing that has worked, right? And really keeping in mind, like, why are we investing? Because we want to be able to pay for college. Why are we investing? Because we want to be able to retire one day, not just to make money for the sake of making as much money as possible forever and ever. Always trying to keeping that why in the back of your mind, so that what I find now, especially when inflation takes hold, when those savings, doesn't pay as much, like Dominique was saying, is that what we end up with is too risky of portfolios for when we're trying to accomplish something, and when there is the inevitable downturn, because it's not an if, it's a when it will happen. When you're too risky and not prepared for it, again, going back to being able to tolerate those ups and downs. And if your goal is really soon, you don't want to lose it all, right? And I've seen it, unfortunately, we all have, right? So just always keeping in mind the big picture and making sure that it's really robust, like Dominique's talking about, and diversified, but lined up with what you want, and always keeping that in mind is hugely important.
Yeah.
Right. Absolutely. So Ryan, speaking of risk, what would you say are some of the common mistakes both new and experienced investors make when investing?
Well, going back to not keeping the big picture in mind is a big one, but I just sort of talked about that. When it comes to risk and not understanding and having that clear expectation of what the risk of a certain investment or portfolio really is, there's two big ones that I really see, right? And we saw this a lot, unfortunately, in March of 2020, panic selling, right? Is abandoning and not keeping that big picture in mind. And even if a goal is a really far away, of just remembering that you're investing for the long haul if it is going to be really risky, right? So the only way that you really have lost that investment is if you sell it, right? And so keeping a level head and don't feeling like you have to, jump off that right? Half my job in March was like, come back, walk back, right? Like, reach out, don't hesitate to ask. Back, right? And that can be one of the harder parts. It's easy to come out not knowing when to get back in. And I have people here still waiting for that moment to get back in, right? And so always keeping that in mind and try not to panic. It's so difficult because, we're talking about all these investments and limit order, things like that is very quantitative, but investing is emotional, right? It is very difficult. And this is the money you've worked so hard for, right? So we want to make sure it's working as hard as possible for you, right? But don't fire it because it's underperforming today, right? That's kind of the idea. Let it keep going and just try to hang on. So I know Dominique probably has an answer to this question too.
Yeah, no, I agree with what you said. I think it's, as you mentioned, you made it one of the points. I was like, yes, very true. Investing and trading is very, very emotional. And you need to focus on what you can control when you're investing and honestly trading too. And there's a difference. And I keep saying investing and trading because they are different. Investing is more, putting your money into something and allowing it to grow over time. versus trading is when you are making more frequent transactions to create more consistent income, right? So when you're thinking about those emotions, I will tell you, and I'm sure Ryan will agree, the one thing you cannot control is the market. You cannot control the market. If the market's going to go up, it's going to go down, side, whatever. You cannot control that. But focus on what you can control, right? Which is your emotions, and focusing on your why, and keeping in mind, not letting greed get in. And I've seen that a lot, especially over the past year. People, Ryan hit on this point where maybe they had one big win, and they think they can keep constantly getting these wins. And I've seen people make a lot of money and then quickly lose all of that money because they think that they're going to continue to win that way. So I would say I agree. Just focus on controlling what you can control, which is your emotions and how you feel and how you are managing any money that may be coming your way. And then also not going into the markets, even with investing or trading, but from a area of need, right? You never want to come in like, oh, I need this. And I've seen people do that. I need to make this money to pay this. I need to do. And when anytime you're coming into something from emotion of need, that's when those emotions start coming in and we tend to make bad decisions, right? So really think about these things we're talking about today as ways to grow your wealth, not to pay your rent, right? But to grow your wealth over time, and provide those additional income streams maybe later on, maybe not immediately. But yeah, it's very important to control your emotions. That's so important.
And I think that the flip side of that in terms of a mistake, is being so afraid that you never invest, right?
Yes.
I've seen the total opposite of what we're talking about right now, right?
Total opposite.
Yes, and is to say, okay, I'm going to save my money, and just like how Dominique is saying that investing and trading is different, saving and investing is different, right? And so I'm going to save my money, and I see this so common. I'm putting money aside, and it's in this big account and doing absolutely nothing for me. So you're saving it, and that's wonderful, but realizing that without investing it, right, it's not going to then work for you as hard as you've worked for it, right, to try to put it in there. And then the other part is sort of a myth or a common mistake is that you have to be either all in or all out of the market, right? And that's where the diversification comes back into, is to saying, okay, what's the time frame? What are you hoping to accomplish? And let's even say a goal is 20 years away, right? Where someone in my seat, or even one of those robo-advisors, right, would just sort of put you in a portfolio that's super, super aggressive because it's 20 years away. If you're not truly comfortable with it and you're not going to stick with it in those rocky moments, it's not appropriate for you, right? And so having that understanding is really important. It doesn't mean that nothing's appropriate for you, but it means it might be somewhere in the middle, right? And so understanding who you are and the type of investor you are too. And again, talking this out for the people either in my seat or with your friends or your parents or the people that have invested who've gone through these market cycles maybe a few times now, and maybe you never have, right? Or that you never have with bigger dollars is what I've seen too, right? Is people got started maybe 10 years ago and they say, I could watch my, small amount go up and down, but whoa, this is way bigger now. This is everything I've worked for. And this is like serious to go up and down. And it feels really worse because most of my clients don't think in terms of percentage. They think in terms of dollars. And so they say, oh my God, my money's disappearing. I can't take it. But you have to make sure that it's appropriate. And that's what we're here for. So here to help. That's why Dominique's trying to demystify everything to make sure it's easy to understand, which is great.
Exactly. Yeah. Dominique, I have another question for you. So earlier you mentioned that for people who are just starting out investing in stocks, it's generally a good idea to invest in the companies that you believe in. What advice would you give for them after they've bought their first shares? What should they do next?
Yeah, that's a good question. That's exciting. So, you've bought your first share, right, of something that maybe you like or believe in. My recommendation is to keep going. If you've identified that, hey, okay, I bought, a share in Apple, and this was good. It felt good. I see maybe I gained a little bit of money. I would recommend just starting to do something consistently. I think that's very important. So setting a dollar amount and saying, hey, I'm going to allocate, $200 a month. $200 a month, I'm going to have it set aside to continue to buy shares of Apple, right? So every single month, on the second of the month, I'm going to have money that automatically goes from my checking account to my investment account, and it's going me more shares of Apple every single month, right? And this is, a strategy called dollar cost averaging. So you're not trying to time the market or anything. You're just letting it go inconsistently. That's one of the things that we're doing for my oldest. She's 2, but she's on track now to be a millionaire by the age of 16 with the things that we have in place for her. But now my goal is to cut it down to 13. I think I figured it out with some calculation, but literally even just using that simple process of dollar cost averaging. So I would say just continue investing. Don't try to now that you bought one share, you need to time it and buy it on the day that it goes down again. Don't make it complicated. Just take it, pick an amount. Everyone should do that right now. Pick an amount and say, okay, this is how much I'm going to commit to investing every single month. Have it set up to go automatically. Don't make it be something that you have to physically go do because you'll forget. So just have it set up to go every single month to buy more of that respective stock, or maybe go into a mutual fund, et cetera, et cetera. But that's what I would recommend to do, because that's how you to start accumulating stocks, and more stocks, and hundreds of stocks, and thousands of stocks, which you can use for retirement, or buy a home, or pass down to the next generation. But that's how you start creating that portfolio of investments if you're just getting started.
Absolutely. Absolutely.
Automate. The more you can, the better it's going to go. Yep.
Yep. So I feel like this question really wraps up everything we've talked about. What do you think people can do right now to get a head start on their finances?
I'll take this one, and then Dominique can wrap it up. I think, especially from a planning perspective, right, is the number one thing I would say is the place to start is get organized, right? Have an understanding of what you have, could be the income you have coming in versus the expenses you have coming out, and what can you save, right? And begin that process, right? Like Dominique was saying, but just understand, where are the accounts that you have? If you're married, make sure both people understand where everyone's accounts really are. What are the benefits that are offered to you, through your jobs, or your spouse's job, right? Or your partner's job. And so I think really understanding what you own, where it is, and then you can understand, is it serving the purpose of what I'm trying to accomplish with this account or this fund. Getting organized is always going to be step one, because it then naturally lends itself to, okay, step two is where to invest. So step one for me would say get organized, because then you're off to the races. Dominique, what do you think for your side?
Yeah, I have to second everything that Ryan said. Getting organized and just knowing where you are currently financially is honestly one of the most important things that you can do when you're starting to figure out how to take control of your finances, and starting to figure out how you're going to create your own path, or to wealth, if that's something that you desire. You can't create a goal, right, of where you want to be if you don't know where you currently are. So that's very important. Like Ryan said, just knowing where you are currently financially, how much money you have coming in, what your expenses are. Do you have any debt? Do you have any investments? Do you have 401ks offered through your job? Are you taking advantage of those things? Or do you have profit sharing plans, et cetera, et cetera? Get a really good understanding of where you are. And then from there, you can start building out, what it will take to hit whatever your goal is. If that's a certain income goal, or if that is a certain, a goal that you need to retire or quit your job or buy your home. But it's very important to figure out where you are currently. So I would definitely agree with that. And like I used to always say, understanding your 2 magic numbers, so how much you're bringing in and what your expenses are as well. I think that's very important. But I think that's truly, if you're just talking about starting point, that really is the starting point.
I have to say too, that, and this is a really important thing to understand, at least from, I know Dominique has talked about, a lot of different platforms, but that process right there of getting organized, understanding your income versus your expenses, and setting up that broader, sort of financial projections in your financial picture, that is what I do. And to sit down with someone like me at Fidelity does not cost you anything to do that, right? People don't believe me. They think it's not true. It is absolutely true. Please do not hesitate to call us, to find us online. You absolutely can do that. That is what we're here to help. And then we can help you figure out what is best for you from there, right? But that whole process of setting that up, we feel you're entitled to it. So call us.
Absolutely. Well, thank you, Ryan and Dominique, for all of your insights today. And thanks to our sponsor, Fidelity. The message is this: the best time to start building wealth is now. While there isn't a one-size-fits-all way to go about this, your risk tolerance, time horizon, and goals will play a huge role in how you invest. Thank you all for being with us. Let us know what you took away from today's conversation about investing through the hashtag #MasterYourMoney on social media. A recording of this event will also be available on Insider's social channels if you want to revisit it later. In a few moments, our survey will pop up on your screen. We'd love to hear your feedback. Thank you for being with us.